In this session, we are going to look at the mechanics of futures market. So, we are going to look at the key specifications, the components of a futures contract. We'll talk about why the futures price will converge to the spot price as and when the expiration date is approaching. How does the concept of margin work? Right? What is this the OTC markets are imbibing from the futures markets? Over the counter markets typically dealing with forward swaps. What are the key features of this futures market or the exchange traded kind of a market, which are taken as lessons by the over the counter markets? Key elements of the market codes for futures, the delivery mechanisms associated with the futures, different kinds of traders, different types of orders. Then we'll talk about the regulation. What are the different kinds of regulations that are associated with the futures contracts? We'll look out from the accounting dimension, and towards the end we'll do a quick summarization of forwards versus the futures. So these are the different things that we are going to cover as a part of this session. As a quick introduction, nowadays we see futures contracts are traded across the world. Now, just take an example. Let's say on June 5th, which is today, a trader sitting in New York, he will call his broker. What is that he gives an instruction to his broker to buy some 5,000 bushels of corn, which would be delivered in September. So on June, he is getting into a contract. He called up his broker and the instruction is 5,000 bushels of corn. And he wants to buy it in September, not now. So that is making it a futures contract. Now this broker is on the exchange. Now this broker, he is issuing an instruction for 1 September corn contract. So remember the terminology, September corn contract. So corn is the underlying asset. September is the typical delivery month. We'll talk about these words. Now each contract, here we are talking of exactly 5,000 bushels being delivered. But at the same time, right, probably around the same time, a day here and there, we are looking at another trader in some other location. He has instructed his broker to sell 5,000 bushels of corn in September. So this person wants to sell corn 5,000 bushels in September. The earlier person wanted to buy 5,000 bushels of corn in September. Now this broker has issued a short option, shorting or a sell of one contract. Now both of them, now there is a buyer who has placed a buy order for September buying. There is a seller who has placed the order for September selling. Now depending on the number of buyers and number of sellers, a price would be determined and the deal would be done. When we talk about the traditional open outcry process, both the brokers of both the buyer as well as the seller, they will meet on the exchange, they will agree upon the price and they will take the process further. So that's a physical meeting. Whereas when we talk about the electronic trading, people are entering their orders from their locations, computer is simply matching the trades. And the price, the futures price is purely determined based on the supply and the demand. More number of long positions greater than the short positions, means more number of buyers compared to the sellers. We see that the futures price is going to be higher and higher. If the opposite occurs, the futures price is going to go down. And a few interesting points to observe. Many a times, though we talked about a person has entered into a contract in June for a September delivery, right? Whether it is a buyer or a seller. Many a times what happens is this position will not go until expiry, will not go until delivery. Many traders close out their positions much before the delivery period itself. When I say close, okay, this person has got into a long position, means he has placed a buy order that he will be buying 1 or 5,000 bushels of corn in September. Now, probably, let's say by July 20th, what this person may say is, I will sell 5,000 bushels, which is one contract of corn in September itself. So he is buying on one side, he is selling on one side, and both buying and selling are happening in September itself. So they are as good as they have cancelled out. Now he might have agreed for a buy price of some $100, and here he might have entered a sell price of $102. So now this $2 is going to be the profit on the expiration date here, right? Because he would be buying at 100 on that day, he would be selling at 102 on that day, right? So he is closing out the position, means virtually that position does not exist anymore. He knows how much profit he is making in the whole process. So the gain or loss is determined by the change in the futures price. Here the futures price was 100, here the futures price is 102. The change in the futures price between the initial date and on the date on which the contract got closed. Now this is what happens with almost 95 to 99% of the futures contracts. Very few futures contracts will go for delivery. So what do we do when it goes for delivery? We'll discuss it slightly later in this session itself. But very few of them will go up to delivery. Majority of the positions are closed much before the delivery date itself. Then, if I look at any typical futures contract that is listed on any exchange, the exchange will come out with a very clear details. Some of the details, especially talking about the exact nature of the agreement between the two parties, it has to be very clear of. When I say that, it has to very clearly specify what is it the asset. First of all, is it a commodity? Now I need to know whether it's a commodity or a financial asset. Because when it is a commodity, there could be a lot of things that differentiate. Quality could be a different kinds of qualities could be there. Probably if I am talking of some kind of an oil, the quality, the purity of the oil is an important aspect there. So the exchange has to very clearly specify what is the grade that it is accepting. If it is accepting a range of grades, what are those different kinds of grades? What is the mechanism to determine which grade it falls into? All those things have to be very clearly specified by the exchange. But at least when it comes to financial assets, they are very well defined, because if it is a share, yes, it's a share of a particular company. Again, there is nothing to talk about the quality of a particular share. Right? So that's the reason from the financial assets perspective, we hardly find any big problem when it comes to the asset quality and all that stuff. But with respect to commodity, the grades, the quality, all need to be very clearly specified by the exchange. Then exchange should talk about contract size. Means one contract equal to how many units of that particular asset. In the earlier example, if you remember, we said one contract equal to 5,000 bushels of corn. Now this is what has been fixed by the exchange. Now this number, whether to set 5,000 or 1,000 or 10,000, is done by the exchange. What is the amount of the asset that has to be delivered in one single contract? Now exchange has to be very careful here. It should be very careful in setting, because if it is setting too large, probably it might not be suitable to everyone. People who want to hedge small exposures, who don't want to invest heavily, who don't want a big risk exposure, even as a speculator who wants to take very small positions, they will not be able to take, because one contract is having so many units of the asset to be delivered. So the cost of it is going to be much higher, and many participants may not be interested in it. But at the same time, if the contract size is too small, so many contracts are going to come up, and the cost of, because there is a transaction cost that is associated with each contract, the trading may become more and more expensive. So the exchange has to draw a balance as to what should be the optimal contract size, so that it doesn't look too high or too low. So even that is one specification that is expected from the exchange. Then we are talking about the delivery arrangement, the place where the delivery will be made. In some cases, that too, we are talking about just 1 to 2% of the typical transactions they lead up to delivery. But when they go up to delivery, we need to have a very good clarity in terms of place where the delivery will be made. And that too, this becomes more and more important if there are significant transportation costs. If the weight of that particular commodity is much higher, it needs to be transported. Probably there needs to be a lot of care in terms of transportation. In that kind of a case, the delivery arrangement will become one of the key aspects. And even that could influence the price which the short position would be receiving, the seller would be receiving, because it may differ from the delivery location. The more and more closer is the delivery location, probably the amount that the short could be receiving might be lesser. The more farther it is, the higher would be the amount that would be received by the short. But whenever, see here, the delivery period will be specified by the exchange. So it may say that delivery can happen anywhere between 1st and 10th of a particular month. Now, when it should be delivered, when that particular product needs to be delivered, it's purely the decision of the person who is in the short position. But whenever he wants to deliver, he is filing a notice of intention to deliver through his broker with the exchange. We'll talk about the full-fledged process in case the short wants to deliver. What is the overall process? We'll discuss about it in a while from now. Then, the delivery month. Every futures contract, it is referred to by delivery month. In our example, we talked about September futures, or we'll have August futures, April futures. So it is referred by delivery month. Now, within this month, when is the delivery made has to be specified by the exchange. Some exchanges say it's the 20th working day, or some exchanges may say anywhere between 11th and 20th of the particular month, or 20th day, calendar day, 11th to 20th dates. or it may say last Thursday of a particular month. So different exchanges specify different, either one single day or a range of days. So exchange will clearly specify what is the delivery period, and this delivery period has to be chosen so that the needs of all the market participants are met. And the contracts wise, you will find that they are all traded to the closest delivery month and a large number of subsequent months. So if I am talking about 1, 3, 6, 9, 11 as the delivery months, and today I am in June, so I'll have both June futures, September futures, November futures, and even the next year January futures as well. So this is what we call as the near month. So near month as well as the subsequent delivery months could be there, and exchange very clearly specifies that the time period like this 11th to 20th is the delivery period. Now for this, let's say for June delivery, when is the trading starting? When is the trading going to end? For June delivery, what is the start date of the trading? What is the end date of the trading? This has to be very clearly specified by the exchange. And what we generally observe is, let's say it says, okay, for June 2015, the trading is starting on 1st April 2015 and it goes up to 10th June 2015. Now, in general, what we see is the trading generally ceases a couple of days before the last day. We'll talk about it why, but one major reason being the parties who don't want the delivery to be taken, they will try to close off their positions much before this end date itself, so as to make sure that they are not forced to take the delivery. They try to close out their positions much before the end of the trading itself. That's one of the prime reasons the trading ceases a few days before the last day. Then the price codes, they are purely defined by the exchange, whether it would be in dollars, whether it would be in rupees, right? It would be in rupees and paisa. What would be the tick size? What would be the change in the price? So if right now the price is 101, what would be the next price? Is it 102 or would it be 101.5? What would be the tick size, which is the incremental value in the price? All these things are clearly defined by the exchange. Then the exchange also comes out with a price limit as well as a position limit. Position limit talks about number of contracts that a speculator may hold, maximum. So a person who is in a speculator role, he can't have more than some X number of contracts. The prime reason being, by holding more number of buy contracts or sell contracts, we really don't want one single person to dominate the market entirely and influence the price. So the exchange has come out with position limits for that. But at the same time, it may even come out with price limit, which is talking about the daily price movement limit. So let's say today the price is 100 and it has set the price limit as 3%. So, okay, compared to the previous day, so if it goes to either 103 or 97, it means that the price limit has been touched. This is called as limit up. This is called as limit down. Price moves down from the previous day's close by an amount equal to the daily price limit. So if the daily price limit is set at 3%, 103 is called as a limit up, 97 is called as a limit down. When I say limit move, it could be in either of the direction. And once this limit is reached, we are saying that the trading ceases, trading halts for that day. Because I don't want a significant price movement on one single day. because of the speculative things that people have got into. I don't want the drastic up or down movement in the price in one single day. And that's one of the prime reasons the price limits are typically applied. But of course, if there could be a scenario where one single security, it must genuinely have moved more than 3% either in the upward or downward direction, right? For those kind of securities which are really without any kind of speculative motive, which are really advancing or declining rapidly, this kind of price limit, halting of the trading, these kind of things, they act as artificial barriers. So the exchange really needs to be very much careful in terms of identifying what should be the appropriate price limit. It should not happen that that particular stock, which is that particular contract whose prices are increasing or decreasing rapidly, they are getting a barrier because of this price limit that is being set. Now, another important point that we really need to understand is as the delivery period is approaching, as and when we are coming closer and closer to the delivery period, the futures price is going to converge to the spot price. And on the delivery date, they should be equal. Futures price should be equal to the spot price. Because there is nothing called future. For that same delivery date, on that delivery date, there is nothing called future. So the futures price and spot price should be the same. Otherwise, there could be kind of arbitrage opportunities that could be exploited. Just think of it like this. During the delivery period, if I assume that the futures price is greater than the spot price. Now, the immediate thing that comes to my mind is, okay, sell the futures, buy in the spot. Because spot is available for cheap, futures is available for expensive. So I'll sell the futures, buy the spot. Now, because I am buying in the spot market, right? I've sold in the futures, I got some cash. Using this cash, I have bought the asset in the spot market, I'm making the delivery. Now, the difference, because I have sold for a higher price, bought for a lower price, obviously I am going to make a profit. And that too riskless profit. Now, if I am able to make it, everyone else is able to make it. So, we see that as traders look at this kind of an opportunity, they start exploiting it. The moment they exploit, more and more selling happens in the futures market. So the futures price is going to fall. More and more buying is happening in the spot market. Spot prices are going to increase and resulting in both of them coming equal itself. The same logic goes if the futures price is less than the spot price also. So I'll say because the spot price is higher, I'll sell in the spot market. Selling in the spot market is more of shorting, and I'll go for a long position in the futures market. Now when I'm going long here, I'm waiting. Right, today in the current market I've shorted. I'll buy it in the future date at a much lesser price. I've already agreed upon the price at which I would be buying. I'd be buying in the future at a much lesser price and I'll be waiting for the delivery. So again, there is a kind of a profit that we are going to make in the process. So you will typically, and that too again, because of this, again everyone is trying to exploit this opportunity. So the futures price is going to go up and up because a lot of people are getting into buy positions and they are not closing out their futures position. So more buy positions resulting in the futures price going up and both of them will again match up. So that's the reason we see irrespective of whether the futures price is above the spot price or below the spot price, as and when we are coming closer and closer to the maturity period, we see that the futures price has to come closer and closer to the spot price itself. So that's an interesting fundamental that we really need to be comfortable with. Then the other point that we are trying to look at here, operation of the margin process. This is one key thing that is separating the futures from forwards. Right? Any investor, look at the process now. An investor is contacting his broker to buy futures. Now, broker immediately he will ask the investor to deposit the funds. Right? Broker is asked now the investor is depositing the funds in a margin account. This margin account will be operated by the broker. And now there is an initial margin. Right now, let's say even the seller, okay, we are talking about a buyer, he want to buy futures. There is a seller, he want to sell futures. Let's assume for simplicity both of them are with the same broker. Now what the broker will ask is, he'll ask the buyer to deposit some funds, let's say $100. He'll ask the seller also to deposit some funds in a margin account. Now this initial amount that is deposited at the time the contract is entered is what we call as initial margin. Right? Both buyer and seller, both of them are depositing that. Then there is a process called daily settlement or mark to market. At the end of each trading day, so this is a settlement that is happening every day, margin account is adjusted. So if there is a gain for the buyer, his account will be updated, let's say by $2. And if there is a loss of $2 for the seller, his account will be updated by a loss of $2. So the margin account is adjusted to reflect the investor's gain or loss on a daily basis. And so this is an account that is updated on the daily basis. But remember, this is not just an arrangement between the broker and the client. Now this broker, right, if let's say here this broker had a loss of $2. Now this broker has to deposit this $2, has to pay this $2 to the clearinghouse. And this clearinghouse, it will pass this $2 to the broker of this particular party who has gained. And this account of the broker is updated by receiving the funds from the other. So there is a real money that is passed from one side to the other through the exchange's clearinghouse. And because here the initial margin is 100, whereas now the margin account has gone to 102, this party, if he really wants, he can withdraw the $2. Anything excess of the initial margin can be withdrawn. But at the same time, okay, one more day transaction, okay, this party has gained another $5, so obviously going to 107. This party has lost $5 going to 93. Now this party's position is going down and down and down like this. Now this is where there is a concept of maintenance margin. This maintenance margin ensures that the balance in the margin account never becomes negative. So generally it is set around 75% of the initial margin, but the intention is this value should not go negative. So probably the moment this account comes less than $75, this is where the maintenance margin limits are breached. So the moment this position of the margin accounts value comes less than $75, the investor receives a margin call. So this person will get a margin call and he is expected to top up. So he has to take the amount back to the initial margin. So he has to deposit the $25 to take it back to the initial margin before the end of the next day. And that $25 which he has to deposit, to take the margin is more like a caution deposit, to take the margin amount back to the initial margin levels is called as the variation margin. In case this party failed to provide that amount, then the broker can very comfortably close out the position and do the settlement accordingly. And few more interesting things with respect to that margin accounts. Whatever the initial margin that has been deposited with the broker, generally the broker will pay interest on that. So just a cash based interest, so there could be a competitive interest that could be paid by the broker, provided cash is deposited as a margin, because in some cases people might even deposit securities. Treasury bills can be deposited as margin, but of course they will not be taken at full face value. They are taken only at 90% approximately, and in some cases even shares can be deposited as margin, which will be valued at only 50% of their value. Right, so in some cases even the securities can be deposited as margin, but when cash is deposited, there is a possibility of earning interest on the top of it. And as we have mentioned in the earlier slide, at the end of every day, the gain or loss which each investor has got is added to his margin account. So which means the money is already, now let's take an example, right? Let's say A and B have agreed to buy 100 units of some X at $100 per unit, $100 per unit. So the contract value is $10,000. Now the exchange may say, or now the broker might say, 10%, now you are a buyer, seller. Now exchange might ask, or the broker might ask both of them to deposit 10% of the contract value as the initial margin. So both of them are depositing $1,000 as a part of their margin account. Now let's say after one day, the price of this has changed from 100 to 100.5. Now because the price of it has gone up, the buyer has gained. The buy position has gained because he would be buying it at 100, whereas the market price is 100.5. So buyer is gaining 0.5 on each. So because buyer has gained 0.5 per unit and there are 100 such units, the gain to the buyer is $50. So at the end of one day, the buyer's account will become 1050, the seller's account will become 950. Now let's say after one more day, the price of it has gone to 102. Now what happens is the comparison will be done with respect to 100.5, because the gain relating to this has already been added to the buyer's and seller's account. Now it's as good as I'm starting a new contract at 100.5. Now if the price has gone to 102, again the buyer has gained $1.5 per unit. And because we have 100 such units, we are talking of $150. So the buyer's position is going to become 1,200. Seller's position is going to become 800. Now if I look at the seller's position, it has come already 80% of the initial margin. Now probably one more such kind. Now here every day the contract is closed and a new contract is coming up at the new price, right? So the value of the contract is becoming zero at the end of every day. Now let's say one more day, now the contract is getting at 102, now the price goes to 103, again there is a gain of $1, 100 units, so this account is going to become 1300, this account is becoming 700. Now this is where the problem comes. Now this the maintenance margin is, let's say, 75%, 700 is much below the maintenance margin. So this party will receive a margin call, and the margin call will demand a deposit of $300 back, so that it goes back to the initial margin. But at the same time, now the price is 103. So the contract value will become 10300, and even if I go with 10%, the margin now will be 1030. He has to take the contract back to the initial margin, so which means he has to deposit $330 to take the margin back to the initial. So this is what happens as a part of any futures transaction. Minimum levels for the initial and maintenance margin are set by the exchange's clearinghouse, and it should not be again too high or too low, because if it is too high, right, if the initial margin is too high, the number of contracts that are traded will go much lower. So the kind of transaction based revenue that exchange is going to get is going to go down. But at the same time, if it is too low, if the margin is set too low, there is a chance for higher defaults to occur, because a big volatility in the price could eat up all the margin money, which can result in a person defaulting, not paying anything. So the margin setting is done by a few algorithms, but majorly it is looking at the variability of the price of the underlying asset, and depending on how much volatile the price of the underlying is going, this would be either adjusted in the upward or the downward direction. And individual brokers may require greater margins from their clients based on whatever the exchange clearinghouse might have decided. Depending on the credibility that is associated with each of the individual clients, there could be a higher or a lower margin that can be set by the broker. And in general also, the other way to look at, if a person is, or if an organization is in a hedging role, then the margin requirements may be much lesser, because the chances of default are much lesser. They have got into it to protect themselves against their existing risk. So the margin requirements are lower in the role of a hedger, whereas they are much higher when getting into it as a speculator as well. Then a few more interesting things. Here, compared to the hedger, we see that the margin requirements might be even more lesser for day traders and spread traders. When I'm talking about a day trader, we are talking about, okay, I have opened a position today, I have closed the position also today. So there is no open positions at the end of the day by the day trader. So the risk is much lesser, because the chance of volatility and all are not coming up across the days. Within the day itself, the position is getting closed out. So the margin requirements are much lesser in case of a day trader. Similarly, when I am talking of a spread trader, he is buying a contract on an asset for one maturity. He is selling a contract on the same asset for a different maturity month. So he wants to play on the price difference during this period. Now, even in this case, the risk is much lesser, because he has got into both the positions simultaneously. So obviously, in these two cases, the margin requirements are much lesser than in case of typical hedge transactions also. And one more thing we need to understand, margin requirements are same both for a buyer as well as seller, long position or short position. And the whole purpose of margining, as we have been looking at till now, it is to make sure that the funds are available with the exchange in case the other party is defaulting, and the party who has made a profit, they should not lose out, because the party who has made a loss is defaulting in the process, right? So that's an interesting concept that has been created by the exchange, and it has been working quite comfortably in the futures market. Now, coming out to the clearinghouse, a clear understanding of the same. It's an intermediary in the futures transactions. It guarantees the performance of both the parties. So none of the parties need to be really worried about the possibility of the default by the counterparty. Now each clearinghouse has a set of members. Now these members, they are the ones who do the clearing and settlement process. When we talk about the brokers who accept the business from their clients, who accept the trade from the clients, and if this broker is not a member, the entire business has to be routed through a member to the clearinghouse. And the steps are like this. The exchange clearinghouse, it has members, right? And members can directly deal with the clients, or there could be brokers who might have clients. Now again the tree could be, it could directly come here. Now these two could be the same as well. All these things are very much possible. Now this parties will post a margin with the clearinghouse. These parties will post a margin with this. Right? If these are both of them are the same, then this is the link that is working. If both of them are different, again through the member there is a margin that this is depositing. So the members, they place some kind of margin with the clearinghouse. They post the margin with the clearinghouse. The brokers, if they are not members, they post the margins with the members. The entire clearinghouse, the task is monitor all the transactions during the day and calculate the net position, how many longs, how many shorts, then aggregate them and compute the net position for each of its members. And when we talk about the members per se, these members have to deposit initial margin based on the total number of contracts that they are dealing in that particular day. But of course, this total number is purely based on a net basis. So I look at number of long positions in an asset, short positions in an asset. I offset the long with the short, and only the net is the number of positions that are outstanding, and the initial margin is calculated purely on the basis of net. And for the clearinghouse members, there is no concept of maintenance margin. And whatever is the change, every day there is a daily settlement process. But whatever is the loss or a gain, in case there is a loss, whatever is the loss amount, it is not required to wait until the maintenance margin. Whatever is the loss amount, that loss amount, which is the variation margin, it has to be paid to the clearinghouse. Whatever is the gain amount, there is nothing again called maintenance margin. Whatever is the gain amount, the clearinghouse is going to pay the member with that excess amount. So on a daily basis, there is a settlement that is happening. The loss or gain that comes out of it is paid immediately. Along with that, the clearinghouse is required to contribute. Sorry, the each member is required to contribute to a guarantee fund in case any member fails to provide that variation margin, to make sure that the exchange is not going bankrupt, to make sure that the exchange, the sufficient funds are available with the exchange or the clearinghouse in case any one of the members is defaulting on providing the variation margin. This guaranteed fund is collected by the exchange. So these are all layers of protection which the clearinghouse has set. Now all these concepts, especially the fundamental of margin and clearinghouse operations, they are very much imbibed by the OTC markets after the financial crisis. Because we know that in case of OTC markets, there is a more of one-to-one kind of an agreement between the parties. No exchange is there. So we have already understood that the credit risk is comparably higher in case of OTC transaction. Now this is where central counterparty, which act more or less like an exchange of the futures market, the role of the central counterparties is designed more or less in the same way, right? So the members of the CCP, again CCP has members just like exchange. They provide initial margin. Any kind of shortfall or excess is handled through variation margin. Shortfall needs to be deposited back, and at the same time each member of the CCP has to contribute to a guarantee fund to make sure that if one of the members fails to make the payment of the shortfall amount, then this guarantee fund will act as a buffer. Once the CCP accepts the derivative transaction, it becomes the counterparty to both of them. So it takes on the credit risk of both. So it is typically, again, just like an exchange, there is a transaction charge that it is coming out with. And even here, the transactions are valued on a daily basis. Daily variation margin payment is happening. And just like an exchange, if the OTC market participant is not a member of CCC, then they have to get it arranged. This kind of settlement needs to happen through the member of CCC itself. So today we see central counterparty's role very much in similar to that of exchange, which means probably it's not just the futures and some kind of options that are traded on the exchange. Even it is giving a feeling that the forward, the swaps and other traditional OTC derivative contracts which are traded over the counter, even the clearing and settlement of them is happening through a centralized counterparty itself. So this is what is contributing to the reduction of risk in the entire process. So if at all the CCP is not existing, or CCP is not clearing some amount of transactions, this is where we are bringing in bilateral clearing. Now you could see this is the diagram that represents a bilateral clearing where every party needs to get into an agreement with every other party and the complexity is much higher. Whereas this is the kind of a hub and spoke kind of a model that comes out when we are talking about a central counterparty. But even here, nowadays there is a lot of improvement post the financial crisis. They are getting into a master agreement, both of them. There is a very clear annexure to that agreement, which is called as a credit support annex, or typically in short called as CSA, where it talks about both the parties posting collaterals. A will post collateral with B will post collateral with A. The calculation of the collateral is done. The computational methods and all of them are very clearly mentioned. Right? Similar to the margin required by the exchange house, CCPs are in case of central clearing, CCPs are getting from their members. Even if it is bilateral, each party is getting the amount as a collateral from the other. Again, daily valuation is happening. Collateral is added or withdrawn accordingly. Now, the presence of collateral, it reduces the credit risk directly in a bilateral transaction, because no party will traditionally default because there is some amount of collateral that is existing with the other party. Now, the next part, I'm going to look at the typical market quote. If we look at a newspaper or any source where the futures quotes are provided, we will see the asset underlying the futures contract, the size of the contract in terms of units to be delivered in one contract, the way the price is quoted, is it just in terms of dollars as well as cents, what is the increment, what is the tick size, all those. Along with that, there is a maturity month of the contract. And coming to the prices, we see the opening price, the highest price during the day, and the lowest price during the day. Then there would be a settlement price, especially the previous day settlement price as well as the current. And the important part is the settlement price is the one that is used for computing the daily gains and losses, and transferring money to the margin accounts of both the buyer and the seller, and even determining the margin for the next day. Right? The price at which the contract traded immediately before a day's trading session. That is what we are calling as the settlement price. And in the quotes, we typically see the previous day's settlement price, the most recent price, what is the change from the previous day. All these are seen, which can help us in terms of comparing whether things have gone up or gone down. Then we have two important words to look at in a market quote: the trading volume and open interest. The number of contracts that are traded during the day, buy as well as sell, all put together during the day is called as a trading volume. But number of open positions during the day, number of contracts that are simply outstanding, only long or only short, both of them should be equal. That is what we are calling as open interest, which means if I have gone into a long position but I have closed it with an equivalent short position, then I am not bothered about it. Then it is not considered. In volume, they are treated as 2, whereas in open interest, this is not considered at all. Because this one which was open, now it got closed because an equal and opposite position has been entered into. So large amount of day traders that are there means they open the position in the morning and close it before the evening. So lot of open interest will go down. Volume will be much higher compared to that of open interest because of the presence of very large number of day traders operating in the market. And typically looking at the quotes, especially the settlement prices, we'll make a few conclusions. If the settlement prices for different months, as the period is growing, if the settlement prices are going up and up, as the maturity is going longer and longer, if the settlement prices are going up and up, we call that kind of a market as a normal market. But if the settlement prices are going down and down with the maturity, we call that kind of market is an inverted market. In some cases, we'll have a mix of both of them operating in the market. Now, very few transactions go through delivery. We have already discussed. Very few future contracts, they go until the delivery. Right? But we need to understand, at least for those which are going through delivery, what is the process. And the time period when the delivery can happen, it has to be specified by the exchange. So exchange might say that the delivery is possible for this between 1st to 10th of any month, of that particular month. And it can vary from contract to contract as well. Now, when to actually deliver during this period, it has to be decided by the party who has taken a short position. Now, let's say he decides, I will deliver it on 5th. Now, he will make a notice of intention through his broker. The broker of the short position, he is going to issue a notice of intention to the clearinghouse. And in that notice of intention, there will be a very clear clarity in terms of how many contracts are delivered, right? And especially in case of financial futures, there is nothing else need to be mentioned. But when it comes to commodity futures, we also talk about where location of the delivery, because the costs are associated with it, transportation costs, and what would be the quality and the grade of the commodity that would be delivered. Now, all these are mentioned as a part of notice of intention to deliver. And once the exchange receives all this from the broker of the short, it chooses a party with a long position to accept the delivery. Generally, it passes this notice of intention to the oldest outstanding long position. Right? So that's the reason people think of closing their positions much before this date comes up. Because if they don't close out this position up till this date, probably it may so happen that this person will be identified as the oldest long position, and the notice of intention to deliver would be shared with this particular party. And this party has to accept that notice to intention. If possible, if it is able to find a counterparty within a very limited period of time, it can transfer that notice of intention to someone else, but otherwise it has to go ahead in terms of taking the position. Now, this is where the trading typically halts much before the close of the ending date of the trading itself for a particular month. And when we are looking at from a commodities perspective, whenever we are talking of delivery, it means it is accepting a warehouse request. I'm making a payment, getting a warehouse request. Now, I am responsible, the buyer. As a buyer, I am responsible for all the warehousing costs, all the storage expenses, everything needs to be taken care by the buyer. And whatever is the price that is being settled is the most recent settlement price. And it can be adjusted based on the grade, location, all those things, if at all they have been mentioned at the beginning of the contract itself. And this entire process, right from showing an intention to deliver to that exchange passing on this notice of intention to the long position, long transferring it to someone, and finally making a payment and accepting it, and finally taking the delivery. This entire process takes around 2 to 3 days. Few important things that need to be kept in mind. As far as the delivery is concerned, there are 3 important days. The first notice day, where the first day on which the notice of intention to make a delivery needs to be submitted by the short to the exchange. And the last possible day on which that can be done is the last notice day. And last trading day generally is a few days before the first notice day. Generally a few generally a few days before the last notice day itself. But people, to make sure that they are avoiding the risk of taking a delivery, people with long position, they try to close out much before the first notice day itself. That's the reason this is the officially last day of the trading. But what we generally observe is trading weekends, the number of trades drastically go down a few days even before the first day of notice itself. So these days need to be kept in mind. Then when it comes to cash settlement, especially for financial futures, there is no, at least for some of them like index futures, I can't deliver the index. Index delivery means probably the portfolio of all the stocks that are constituting the index. So it's always a notional concept, but it can't be a physical entity. So some of them, they are inconvenient and impossible to deliver. In that case, there will be only cash settlement. So the prices of them, we say that they are closed as on some particular predetermined day. So that day we are calling it as closed, and all the computations are happening based on the price on that day at the close. So either everything is mentioned. It's at the opening price or the closing price of that particular trading day. Everything is mentioned as a part of the contract, and that would be used for doing the settlements, especially in case of cash settlement process. Then, looking at the different types of traders in the futures market, we have future commission merchants who are purely following the instructions of their clients, and they charge the commission from the clients for doing so. Similarly, you have locals who are the parties who trade on their own account. They are not on behalf of their clients, they are trading on their own account. And just like in any OTC market, even in the futures market, we see hedgers, speculators, as well as arbitrageurs. In speculators, we see three major categories. Scalpers, these are the guys who trade just for a few minutes. They close out their positions in few minutes. They just look out for very, very short term trends. And they are majorly looking at small, minute changes, and they want to take an advantage of that. Their volumes are high, but profit on each one is marginal. Those are the kind of speculators. Then we have day traders who hold for less than a day, slightly more time than the scalpers, but obviously they don't want to wait for a day as well. They really don't want to listen to the news that will occur overnight. Then you have position traders who generally hold for longer periods of time. They really want to look at major movements in the markets and they want to take a benefit out of them. So in the futures market, we see all these three kinds of players operating. Then coming to the different kinds of orders that could be placed, we have a market order, which is the most simple one. The best price that is available at this particular point, just execute it. Very straightforward, which is also called as the current market price, whatever is prevailing. I'm getting into a buy or sell transaction at that particular price. On the other side, we can have a limit order where I'm specifying a price and the order is executed. Let's say I want to buy. Right now the price is $50. I've set a limit order for $47. If the price goes below $47 or at least $47 it touches, only then the trade would be executed. So it is executed at this price or anything that is more favorable to the investor. So it may so happen that this price may not be reached at all, and because this price may not be reached, it may so happen that the trade may not be executed during the day at all. That's one limitation with the limit order. Then at the same time, I have stop order or stop loss order. Let's say I have bought something, right? I have a market price. I have bought it, let's say at 50. Now I'll put a sell order for 47. Now what does that mean? Okay, I have bought it at 50. I'm intending that it will go up. But if it goes down below 47, I don't want to take the loss anymore further. I want to close it off. I want to close off my loss. I want to minimize my loss. I want to restrict it only to $3, not go below that. Now that kind of an order is called as a stop order or a stop loss order. The order is executed at the best available price once a bid or offer is made at that particular or less favorable price. So I am closing out the position in case of unfavorable price movement. I am limiting my losses. Now when I say stop limit order, it's a combination of both limit order as well as a stop order. So I have to specify both the prices, the limit price as well as the stop price. Similarly, we have a market if touched kind of orders. So once a particular price is reached, it will be executed at the best available price after that. So it generally becomes a market order after hitting a particular price. So this is more to ensure that the profits are taken if favorable price movements are occurring. Then we are talking about discretionary order. This is more like a market order itself, but some discretionary powers being given to the broker. If he really thinks that there is a possibility of a better price coming up, he can delay the execution of that particular trade. And all these orders, unless otherwise stated, you see that they expire at the end of the trading day. So that is where again a few time related orders are there. When I say time of the day order, in a particular time frame between 11 a.m. and 11:30 a.m., I want the order to be executed. That is like a time of the day order. Or I can specify it as GTC order, good till cancel, or typically we call it as an open order. So it doesn't get expired at the end of the day until I manually cancel it, or until that contract is over, until that contract is completely expired. Only then this order will get expired. It's not done at the end of the day. And another timing related order is a fill or kill order. It is executed immediately on the receipt, or it does not get executed at all. So if we see, there are so many such kind of orders that are present in the futures market. Again, not all exchanges have all kinds of orders. This is just a collation and a compilation of the different kinds of orders that are selected on different kinds of exchanges. Then, looking out from the regulation dimension, regulation surrounding this futures contracts, regulation looks after the public interest. The major thing coming out of the regulation is the prices, the future prices are communicated at regular intervals, and the traders, they report their outstanding positions on a regular basis. It also takes the responsibility of licensing all the individuals who want to provide services regarding the futures trading. It does some kind of eligibility checks, does a background check, and at the same time there are some minimum capital requirements in case someone wants to become an advisor. Any kind of complaints that are brought by the public, it entertains them, investigates them, and make sure that the disciplinary action is taken wherever appropriate. And it has the power to inform the exchange or even force the exchange to take a disciplinary action against any individual who has violated any kind of rules. So the major intention lies in terms of preventing the fraud, make sure that the market operates very smoothly, and all the actions that are taken by the different participants in the market are always in the better interests of the public, right? And so nowadays, with the Dodd-Frank Act coming up, the responsibility of these regulators has improved drastically. Now they are responsible for the rules requiring the standard OTC derivatives to be traded on swap execution facilities and cleared through central counterparties, more and more bringing transparency into the OTC derivatives trading process. So regulators have a big role when it comes to the derivatives transactions today. Coming to the accounting world, though we are not going into too much of in-depth as far as the accounting mechanism is concerned, but a few important things. Accounting standards, they require the change in the market value to be recognized. See, again, depends on whether I'm doing this derivatives for a hedging purpose or speculation. Now, if we are doing it, okay, let's take an example. Okay, today I've got into a transaction. Let's say today is 20th Jan 2015. I've got into April futures, April 2015 futures, right? I've got into April 2015 futures where the delivery is, let's say, on 20th April. And let's say I have closed this position on 1st April 2015. And or probably 10th April. And let's say on 31st March 2015, I'm looking at something else. Now let's say the price on this date, right? The price on this date is, the futures price is 50. Here it's 51. Here it's 52. Here it's 53. Now this date is literally of no use for me because I'm not going anyhow up till that date. Now I really want to know whether this transaction is for hedging purpose or for a speculation. If it is for a speculation, I will look at every financial year. Okay, I've gotten at 50, but on 31st March, which is the ending of that financial year, the price is 51. So I'll put a gain of 1 on for the financial year 2015 ending March 2015. And between 51 and 52, another gain of 1 I would be putting for the financial year 2016. Now this goes as a part of speculation mechanism. But let's say I'm using it for hedging. And the hedging, let's say I'm recognizing all the profit or loss of my original in financial year 2016 itself. Then this entire 2 I'll recognize as a gain in 2016 only. I'm matching it with the gains or losses of the item that is getting hedged. Now this is where the difference comes. So when if I'm not using for hedging purpose, I'm required to incorporate the changes in the market value of the future contract when they occur. But when it comes to hedge, the gains and losses recognized in the same period in which gains or losses from the item being hedged are recognized. This is called as a hedge accounting. That's one thing that we have to understand. And all the derivatives are included in the balance sheet at the fair market value. Hedging instrument, whatever I'm using, right? Okay, I'm doing from a hedging perspective, but whatever the instrument that I'm using for hedging, to a large extent, it should be able to reduce my risk on a regular basis. And how effective this hedge is, I have to evaluate the effectiveness on a regular basis and submit the report of the effectiveness of the hedge. Otherwise, it will be converted into a speculation kind of a transaction. So whichever the instrument I am using for hedging purpose, I have to really identify the effectiveness of that, and I have to assess that effectiveness and produce a report on a 3-monthly kind of a basis. And finally, just to quickly summarize forward versus the futures. Forward contracts are private contracts between two parties. Futures happen on an exchange. Forwards are not standardized, they are actually customized and they are negotiable. Whereas futures are standardized in terms of quality, quantity, contract size, asset quality, etc. And the delivery date is only one single delivery date, but here you can have a range of delivery dates specified by the exchange. The entire settlement happens generally at the end of the contract, but here we have a daily settlement or mark-to-market kind of a transaction that happens. Here in forwards, you see the delivery can happen or the final cash settlement can happen. Whereas in futures, we see majority of the times it's a cash settlement itself, means the contract is generally closed before the maturity itself. And there is a possibility of a good amount of credit risk in a forward transaction, whereas virtually there is no credit risk present in a futures transaction. So that's all we have as a part of this session, where we tried looking out for understanding of the various mechanics involved the futures market. So just a quick recap on the agenda that we have initially started off with. We looked at the specification of a futures contract. We discussed about the convergence of the futures price to the spot price. We talked about the operations of the margin accounts. How do we look at the principles of the futures market being imbibed into the OTC markets, especially with respect to the collaterals and central counterparties. Then market codes, some important definitions and concepts that are understood through the market codes. The delivery process, how it goes for commodity, who bears what kind of a risk, different types of traders in the market, different kinds of orders, the regulatory aspects, the accounting aspects, and finally we had a quick summary on the forwards versus the futures. Right?